Hello and welcome to the July edition of Market Moves with me, Katrina Gain. So July has given us at least two outright winners. We've had Andy Burnham, who secured the keys to number 10, and Spain were crowned World Cup champions. However, for markets, the results this month have been far less decisive. Just as easing inflation appeared to be strengthening the case for lower interest rates, the ceasefire broke down in the Middle East, putting the focus back on elevated energy and fuel prices. At the same time, corporate earnings have remained strong, offering a snapshot of how businesses are managing higher costs and ongoing geopolitical uncertainty. So where does all of this leave investors? I'm pleased to be joined by our Chief Investment Officer, Patrick Farrell. Great to see you, Pat. Can you talk us through some of the developments that have happened this last month?
Well, it has been another sort of roller coaster ride, I will say. We have seen the ceasefire, and that definitely buoyed a lot of market expectations over the early part of July. But then all that deteriorated because we had 12 consecutive nights of hostilities that basically saw the US and Iran really take it to one another. Markets do get a little bit more concerned to sort of say, actually, well, yeah, we're not going to see that energy flow coming out of the Persian Gulf anytime soon. And we're still in that sort of environment at the moment. Even though the hostilities have actually ended, we are still seeing a very limited transit of oil cargo actually coming through the Strait of Hormuz at this particular stage. And the Iranians are very, very stringent in terms of making sure that no ships are getting through. So at this particular stage, and with the naval blockade that the US have instigated again, we're in that sort of situation where it is a wait-and-see prospect. That said, the fact that hostilities have ceased and the situation now that maybe talks are going to be back on the table, is this more of a propaganda? Is this more of the sort of situation where Trump is trying to engineer some of the oil price moves? I think that, yes, that is the case, but we have to then sort of look through, okay, well, what are the prospects for this going forward? So that's one of the things that's happened over July. It's certainly one of the most important things. The other thing, as you correctly mentioned, UK, we've got a new Prime Minister. Is he focused on growth? Absolutely. And I think that, will he be faced with the similar challenges that Keir Starmer was? Absolutely. So I think lots of noise at this particular point, and I think some of the sort of policy agenda is definitely going to sort of flow through into what does that look like, particularly the devolvement movement, so moving some of the power base out to the broader regions. I think it will be an interesting but challenging sort of prospect for the UK economy. So how that's going to actually eventuate will be really, really interesting. However, what the market has anticipated off the back of this is that we are going to continue to see some of that sort of UK interest, if for nothing else. If for nothing else, in fact, there are a lot of UK companies that actually have very attractive valuations. And we're seeing that in terms of the number of takeovers that we're seeing on the UK stock exchange. So that's not necessarily a good thing, because a lot of that is being taken over either by private equity or by international interests. So that doesn't necessarily bode well for the UK stock market itself, but I think it is starting to unlock the value that a lot of UK companies actually have at the moment. So that's where we're seeing a little bit better performance for the UK indices, and I think that that's probably going to continue a little bit more as we sort of move through. And the third thing is the tech route. So we've gone through an exercise where technology earnings continue to sort of show really strong growth, and surprisingly so. However, coupled with that is the amount of money that they're spending. It's very, very expensive to build out this AI infrastructure. And at the moment, we've seen some of these big names continue to sort of pump even greater expectations of capital expenditure to build the data centers and to build the infrastructure that they need in order to meet the demand. And it is, I will emphasize the fact that this is a demand-led requirement, not necessarily a prospect-led requirement. So, and the unfortunate thing, or fortunate or unfortunate, but the way that we would typically view some of this sort of investment horizon is significantly compressed. So what do I mean by that is that the level of adoption that we're seeing in terms of AI technology is in the space of a handful of years, right? So in order to sort of see some of the 75% adoption of AI, it's around 3 years. Whereas if we looked at other technology like the personal computer or something along those lines, it took 20 years to get to that sort of level of adoption. So at the moment, in order to meet the demand and the significantly compressed cycle that we're working through, you have to spend a lot of money. Now, hopefully, some of those investments will pay off. And I think the market is willing to sort of give them the benefit of the doubt. But at the same time, they're scared by the amount of money that is being pumped into the economy at this particular point.
So, Pat, there's a lot to unpick there. Why do you think resilient investor sentiment remains so high?
If I take my wife's example, for instance, she's using Claude for almost everything. So I think that there is a vision that a lot of investors can see in terms of not just the business application for a lot of AI, but also the sort of consumer appetite for it. I think on that particular front, how they price these particular models is the big uncertainty, and we've already seen significant price hikes for ChatGPT, for instance, and the like. And I think as we continue to become a little bit more dependent, we start to then sort of say, okay, well, is it still worthwhile? And at the moment, the productivity increases that we are seeing in relation to some of the AI adoption is very worthwhile. So businesses will see the fact that, that they will see the gains come through and the benefits start to come through. So I think that that's one of the sort of key things, because investors themselves will be in a position where they can sort of say, okay, I can understand how this is evolving and I can understand how quickly we need to adapt. So on the back of that, they're prepared to sort of give these companies the benefit of the doubt. Obviously, a lot of these companies are using all their free cash flow. And one of the challenges that we see in relation to this is, that they are turning into, from very flexible social media type companies and, search companies like Alphabet, but they're turning into heavy asset companies. They're owning a lot of these data centers. And, they're turning into property managers more so than some of the sort of more flexible social media. That's a risk and a challenge for management. And I think that that's something that we need to consider. But I think where investors are looking to the future, particularly 2 to 3 years out, that their free cash flow that they're earning and the earnings that are going to come from the infrastructure that they're building at the moment is definitely going to be there. It can't be replaced. It's not necessarily like the tech boom that we saw in 2000, where a lot of the infrastructure that was built out to actually supply internet to the houses got made redundant very, very quickly. I think one of the other bigger threats is the competition from China. And we're starting to see some bigger names come through there. Now, I think when we look at what the prospects are, I think China and the US will be dominant in this sort of marketplace. And I think that, the resilience that's coming through from investors in relation to this, given the fact that there are energy shocks that are happening right around the world, so we can't afford to ignore that. But at this particular stage, when we're looking at the retail investor base, particularly in the US, they start to see this is an opportunity. It's almost like a bargain. It's almost like an Amazon Prime Day when they see some of these stocks actually pull back. So they're very quick to come in and to support any sort of pullback in terms of the marketplace. That's a different dynamic to what we're used to. An institutional investor would look at that concern, that sort of marry that concern up with where their expectations are, and then they'd basically be a little bit more cautious. But a retail investor sees a bargain, they basically step.
Yeah, they jump on it. Well, going back to your point around sort of elevated energy costs, do you think with the ongoing conflict in the Middle East and with the upcoming midterms, they're going to want to start to find a solution to what's going on?
I think it's a really interesting question, So, we put a number of different clocks. One is a sort of economic clock around the energy impact. One is a government or a political clock, which relates to the midterms. And the other one is a military clock that we basically put in terms of the conflict and how they can get some resolution. Now, the unfortunate thing is that the political clock is ticking really, really quickly, and we're getting to a point of not necessarily no return, but I don't see a scenario where any sort of popularity gains are going to come back strongly for the Trump administration. Mm-hmm. I think, the popularity at the moment is at very, very low levels, in terms of the way that they've implemented both foreign policy in terms of tariffs, the conflict in Iran, and how the ongoing immigration concerns continue in the US. A lot of that means that the Republicans have very low popularity going into this midterms. I think now we're in that sort of situation where their time has essentially run out. There is not much that the Trump administration can do to actually promote the Republican agenda. So I think it's going to be quite damaging, for the Republicans going into these midterms, with the likelihood that we will now see at least the House move to a Democratic majority, with the Senate in a very sort of 50-50, very tight balance in terms of what that's going to look like. And it's a day-by-day proposition. So we could end up in a situation where Trump is what we know as a lame duck president after the November midterms. I think Trump is also looking at different ways to actually delay the midterms, to either extend the sort of current majority clean sweep that the Republicans have across all the houses. But I think it's going to be a very difficult road for them going forward.
And what do you think the implications of all this will be on the markets?
I think from a market perspective, it might actually be more beneficial because, Trump's powers will be curtailed. Mm-hmm. He will be forced to sort of go back to the House and try to get some congressional approval. I think, though, that he will also see that as a challenge, and it will probably move back to the days of executive orders and the rest of it and emergency powers. Mm-hmm. So I think that that's something that we've got to consider from a market perspective. However, it is going to signal the fact that the powers that the US are exerting right across the world are going to be curtailed somewhat more.
And then turning it back to the UK, with Andy Burnham coming in this month, how has UK markets responded to that?
I think that, having a little bit more of a stability, so the transition to the new PM could have been much more destabilising. And I think some of that now being behind, we've got some certainty in terms of what that looks like. We've got a new chancellor.
How do you think people have responded to Healey as well? I think it was a surprise, wasn't it?
He was a surprise, and I think the bond markets have actually reacted reasonably well and calmly to the appointment. I think it will be a wait and see type proposition. So the UK is not in a position where they can just go forward and spend and try to sort of grow their way out of trouble. It's too difficult at this particular point. We have to be fiscally responsible. Our bond market is very, very sensitive to anything that could destabilise that particular point. And that will then flow on to equity markets and risk assets and the currency much more generally. So he has to be a lot more respectful in terms of what that looks like from a fiscal responsibility piece. But at the same time, it's opening up different perceptions, it's opening up different channels, and maybe that's a sort of trigger point that we need from a UK perspective.
So then looking ahead, what is it that you're going to be watching closely?
I think what we need to watch very, very closely going forward is, if the conflict and the oil restrictions flow continue, and if that moves into some of the Red Sea ports as well in terms of some of that restriction, we're still seeing about 4 to 5 million barrels actually exit the Red Sea from Saudi Arabia. If that gets curtailed and the Strait of Hormuz is still blocked, we could see energy prices substantially ramp up. So that's a concern. And at the moment, what we're seeing is a continual drawdown on the strategic reserves that we have. So we don't have the buffer.
No, because they've been absorbing supply chain shocks quite well to date. But I mean, how long can that last? Maybe we're getting to that sort of tipping point ever so slightly.
I mean, it's a really good illustration. So at the moment, just to give you an indication in terms of some of the numbers, there was about 413 million barrels of oil sitting in Louisiana and Texas in terms of their strategic reserve salt caverns. The US have drawn down 104 million barrels of that reserve, so it's about 25%. It's roughly about 60 to 65% of what they pledged as part of the release of strategic reserves. A lot of that went initially into the commercial reserves, so out of strategic reserves into commercial reserves, but all that commercial reserves has now been sort of run down quite substantially over the course of the last month or so. So now we're in that sort of situation where we've got relatively low commercial reserves, and we've also got only about 40% left in terms of what the US has already pledged. Now they can actually pledge a little bit more, but those caverns can't necessarily go down below 150 million barrels. So at the moment, they're sitting at about 311 million barrels. So there's still some that could sort of come through. But Japan have already released 80 million barrels. That's their full pledge. The UK and South Korea have also released all the barrels that they've pledged. So we've actually pushed out so much oil from the strategic reserves that's actually led to that resilience piece that you were talking about, Katrina. So now we're in that sort of situation. There aren't going to be any sort of significant more pledges in terms of what that looks like, because it becomes quite dangerous, both for those individual countries. So I think that's one of the sort of concerning aspects that we've got as we sort of look forward. I think in terms of the technology space and the tech route that we're sort of going through, markets just will become more familiar with some of the circular financing piece, but they'll also start to really look at whether or not that monetization in terms of all the money that's being spent actually starts to come through. And I think as each quarterly earnings cycle basically goes forward, we'll get more and more clarity as to about how that's going to sort of come back in terms of earnings going forward. So I think that's something that we just need to sort of look at. But the challenge will be is how they're also dealing with the big assets that they're sitting on their balance sheet. So they become much less flexible, and they become much more adhered to in terms of debt issuance and equity issuance, whereas they're not buying back their stock anymore, not at this particular point. So that's something that the market does need to deal with. Overall, I'm a little bit more cautious. I think, that where the market actually got to at this particular stage, there is too much negative uncertainty and a degree of complacency in relation to how the energy shock is going to translate. And I think that's something that we've all got to basically consider. So at this stage, even though the markets are quite buoyant, I think that, just having a little bit more caution as we sort of move into the next sort of 6 months or the second half of this year, I think is going to be warranted.
Well, thank you so much, Patrick, for joining us. There's a huge amount for us to unpick and think about, and we look forward to joining you all next month.